How are we doing, guys? Welcome back to the course. We've just spoken about how fundamentals can be used to gauge the overall direction of a market. In this video, we're going to be talking more so about individual economic news releases and how these sway the market, and the reason that we actually like to avoid economic data releases where possible. So the first example I'm going to show you is some Canadian employment data. Okay, this happened on this day, and this was the after effect of this Canadian employment data. So as you can see, we are on a very low time frame. We are on the 10-minute time frame. Now, this is something that I actually use to trigger entries and also to monitor intraday trending movements and trade movements. So what we saw here was the release of some Canadian employment data, and the employment data was employment change and unemployment rate. So employment change shows the amount of new jobs formed within 1 month, and the unemployment rate shows the overall amount of the able working population that is actually unemployed at that time. So this formed mixed data. We had positive unemployment change, where unemployment gained 952.9 thousand new jobs within that month. On the contrary, though, the unemployment rate didn't actually decrease as much as expected. Okay, so this data was forecasted 700,000 new jobs and a unemployment rate of 12%. Okay, what actually happened was 952,000 new jobs, but the unemployment rate remained above the forecast at 12.3%. So while we did see an improvement month over month in employment, more new jobs, and a lower unemployment rate, the forecasts are where speculation really sits. Okay, the forecasts are where the traders are really looking for market direction. So if we have a super positive forecast and the numbers come weak, like this with the unemployment rate, where it was forecast at 12 and came out at 12.3%, that's actually negative. Okay, that is going to cause a sell-off. On the contrary, though, the positive unemployment change, 700,000 new jobs were expected, and actually 952,000 came through. So that is quite a big leap above the forecast in jobs. Now, what this causes is a mixed message in the market. Okay, we had a downside run and a big upside spike then. Basically, we were in an overall uptrending market as it was, and it looked like the market was making a clear headway. But what we actually got was this run of this recent low before a big fast rebound and upside continuation, and this was caused by that Canadian unemployment rate and employment change data. So that is a classic example of how fundamentals, individual pieces of economic data, are going to affect forex markets. Now, this on the 10-minute chart is not huge, right? This isn't going to be a huge movement, but what it is going to do is probably knock you out of positions. That's why we actually try to avoid trading them, because chances are, say you are long from here and you have your stop beneath this previous buy to sell kind of movement, this mixed data causing this big spike down and then a rebound up would have taken you out of your trade at a loss, or there's a risk of that doing so. Okay, so economic data can be dangerous because it abruptly ends trades, or it causes these big spikes which take you out of your positions and actually put you onto a loss, take you out of your winning position and put you onto a loss. So that's why we actually aim to generally avoid trading economic data. We've spoken about how we're actually going to treat fundamentals earlier in the course. We use this central bank information to gauge overall trend direction and overall currency trends. What we don't do is use the individual pieces of data to try and catch spikes in the market or to try and trade fast momentum as a result of these economic data. Okay, this is essentially gambling. We have our forecast, but we don't know how this is going to come out. As you saw here, we had this data, employment change data, came out above expectations, and the unemployment rate came out below expectations. So for that reason, neither forecast was accurate. And really, that means then trading a forecast is essentially gambling your money and gambling on this trade. So generally then, trading economic data is something that we don't really want to do. The majority of our focus when it comes to fundamentals is going to be gauging the overall market direction and trading in line with that. using the geopoliticals, using central bank information like interest rates and monetary policy that are leading a specific economy. These economic spikes, employment data, and things like that are really just going to cause more hassle than good for us in the market. So that's one example there, showing unemployment data and showing the spikes that come and the difficulty that can actually drive into the market as a result of economic data. Now, there's not really too much more to say. I could show you so many examples like this, but at the end of the day, you're just going to see a lot of messy spikes due to the market noise formed by speculation increasing around these economic data events. So when it comes to fundamentals, you can keep your eye on this data and you can use this data to your advantage by reading it after it's released and looking to trade in line with the trend from there. But really, news is going to be a gamble, okay? The overall fundamental focus should always remain with geopolitical events, central bank data like interest rates and monetary policy, and actually trying to track the performance of an economy to trade in line with the trend. So that is really just bringing fundamentals together, okay? We are going to be focusing on things like pandemics, of course, affecting the whole global economy, wars affecting specific countries, trade tensions are going to cause a lot of issues for, specific currencies and specific countries that are involved. For example, US and China trade tensions are going to cause issues for the US and for China as well. So all these things considered, economic data is really not going to be a big forefront focus in our trading. Okay, we use this to filter trades. We check our Forex calendars, those Forex factory calendars that we spoke about earlier on in the course. We monitor those regularly before each trading session, and we plot down the data that we need to avoid, and we plot down any data that could form some useful reaction. So when it comes to economic data, always keep your eyes on the central bank information, interest rates, and monetary policy. Employment data can be useful as well for gauging direction in the long term and in the actual fundamental picture of things. But when it comes to near-term on-chart speculation, don't stress yourself too much with economics. Try to avoid the big news. And if you are trading positions already through the big news, make sure you get those positions risk-free with the stop loss placement as we mentioned earlier in the course. So thank you for watching. I'll see you over in the next video when we'll go a little bit deeper into fundamentals and begin talking about something called safe haven flow.